the demand for electricity is going up dramatically, and that means we're going to have to invest, find companies that are either going to provide the natural gas or nuclear energy that could provide for more electricity, or also find other companies that are going to modernize our electric grid.
On Wealth Track, our annual strategy session with leading portfolio strategist and financial thought leader Jason Trennert.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Every year at this time since our launch in 2005, I have reached out to a top-ranked investment strategist who has a wide-ranging view of the economy, markets, and the zeitgeist of our time. This year is no exception. We are welcoming back Jason Trennert, a financial thought leader whose research pieces and articles on markets and the economy are read by institutional investors and corporate executives around the world. One of Trennert's most notable calls was the creation of the acronym TINA, meaning there is no alternative to stocks, during the historically low interest rate period of the last 10 plus years until the Federal Reserve started raising interest rates in early 2022. TINA was a major investment theme underlying the bull market. Trennert is co-founder, chairman, CEO, and chief investment strategist of Strategas Research Partners, a leading macro research firm for institutional investors. Strategas is a Wealth Track sponsor. What do investors have to look forward to in 2025? Well, first off, 2024 is going to be a tough act to follow. The S&P 500 posted its best back-to-back yearly performance since 1998, double-digit returns in each year. Bonds held steady with the return on the benchmark Bloomberg U.S. Aggregate Bond Index positive for the year. Gold advanced more than 25%, and Bitcoin, which is now available to investors through several exchange-traded funds, rocketed higher with a 126% gain. And although the final figures aren't in yet, expectations are that the economy grew at a healthy clip and inflation was lower for the year, although still higher than the Fed's desired 2% rate. How does this set us up for this year? We asked Trennert what to expect, starting with the stock market.
Last year, you might remember, it obviously was an election year in the United States, but it was actually an election year for 40% of the world's population. And so in those years, it's not surprising that economic growth is stronger because incumbents generally like to get reelected. And that's one of the reasons why economic growth was stronger. I think it's one of the reasons why the markets were stronger, but also is resulting in concerns, as we've seen recently, about maybe too much of a good thing, at least as far as the bond market is concerned, as bond yields have risen. And also, it was a strange year to the extent to which gold rose at the same time risk assets did. So I think that's indicating to you that there's a little bit of a fragile equilibrium here where people are excited about longer term growth, but they may be starting to wonder whether the fight against inflation is truly over. And that'll be something that, I think this year in terms of the Fed and the new administration, they'll be having to deal with that issue.
So what do you think is going on with inflation?
The good news is it's come down. It's bad news for the worker that there's a lot of pent-up demand for wages to the extent to which inflation grew much faster than wage inflation. And so your average person their standard of living has declined. And that's part of the reason why you're seeing very, very, I would say, generous wage settlements on things like the Boeing machinists union or the longshoremen on the East Coast. Both received relatively high wage settlements moving forward that are not really consistent with 2% inflation. And so this is an issue, and that's one of the problems with inflation is that once the toothpaste gets out of the tube, it gets hard to put it back in because you're constantly fighting the last war. So I think that the progress has been good, but I think the Fed has to stay vigilant. And I hope the Fed doesn't have the temptation to continue to ease too aggressively, too quickly.
Jason, the so-called Trump trade, number one, what is it and how significant is it? And do you think it has legs?
I think it's very significant. I think it has legs. And what it means largely is a focus on deregulation of both the financial sector as well as the energy sector. And it's also a preservation of the Tax Cut and Jobs Act that was passed in his first term in 2017. Without reauthorizing that, taxes will go up dramatically by the end of this year. And it is very much a priority of the incoming administration to preserve those corporate tax cuts, and even perhaps cut taxes further for companies that bring manufacturing back to the United States. But in my opinion, all of that's largely the Trump trade. So it's drill, baby, drill. It's ease financial conditions, and it's also preserving the corporate tax cuts that allow corporations to invest more here at home. And hopefully that provides the productivity that keeps inflation lower and growth a bit stronger. And it's going to be a very meaningful change, in my opinion, in Washington and for the markets.
Does it stand a chance of actually passing?
I think it's very likely, mainly because I think it would be economic suicide for Congress not to extend those tax cuts that were passed in 2017. It would be the equivalent of a massive tax increase from here. You know, it depends on where you're starting, but from here, it would be a significant tax increase at a period of time in which I think the market's a bit fragile. Market's gone up a lot in a short period of time, and I'm not sure you want to take too many chances with that.
By many kind of traditional metrics, the stock market, the S&P 500 specifically, looks very expensive. What is your view of market valuations?
I think it is expensive. I do think that I do have to say that you have to separate out partly with the so-called Magnificent Seven companies from the rest of the market. Without those companies, which are growing very quickly, the market doesn't look quite as expensive as it does. And the Magnificent Seven is pretty magnificent to the extent to which people are paying up a lot for those earnings because they're growing. It seems to be the strongest secular growth story in the market. So I think returns this year will probably be a little bit more muted than we've seen in the last 2 years. It's going to be hard to get big multiple expansion from here. But I also think that earnings should be up we think they'll be up about 10% this year. So we're looking for kind of high single digit types of returns from the market. Probably, again, not going to get the multiple expansion that we saw before, partly because there's some upward pressure on interest rates. But we do think it should be a decent year for the market as a whole.
You mentioned the bond market earlier. So what is your take on the bond market?
We've been spending money in this country for well beyond our means, really, since COVID. And we're running budget deficits that are between 6 and 7% of GDP at a period of time where you have an unemployment rate of 4%. That's never happened in our history. We're spending money as if we're already in recession when we're not, which is a little frightening because if we were to go into recession, the expenses would skyrocket even more than they are now. So I think what the bond market's concerned about really is just the increase in supply of treasuries that will hit the market if changes aren't made. And this is one of the things I think for the incoming Trump administration. DOGE, among our institutional clients, this idea of the Department of Government Efficiency is getting a lot of attention. People are cautiously optimistic, but they're quite optimistic about it, and that if there can be real progress made in terms of stopping some of the wasteful spending, that could go a long way in allaying some of the fears of bond market investors. So that will be something to watch for, it seems to me, this year, how successful they are. And if they can put some points on the board in terms of showing that they're serious about cutting government spending, I think that should calm the bond market down.
I mentioned in my introduction to you that you are known for your investment themes, but I wanted to let our audience know and to remind you as well of the investment themes that you talked about in 2024 when you were on Wealth Track a year ago. And you get pretty high marks, Jason. So deglobalization, AI, allocation to gold, China uninvestable, more risk in passive funds because of the concentration that you have in passive funds, and as you mentioned earlier, the Magnificent Seven, and a justification for the U.S. market premium versus other markets, and all of those turned out to be really good investment themes. The one area that you missed was that the dollar would weaken. It actually strengthened, right?
It did. Certainly since the election.
You know, you've got a lot of credibility coming into this conversation, Jason Schredder.
We'll
So
take advantage of it, right?
Yeah,
We'll-
take advantage of it. So your major investment themes for 2025, I want to talk about those. The bill comes due. We just talked about that a little bit, but the bill coming due being our budget deficits, right?
That's right. And I think the
Right.
administration is going to have its work cut out for it. If it doesn't want interest rates to skyrocket, it's going to have to make some real progress on spending.
DOGE, which we just talked about, and you're talking about it going global. How significant is that? And why is that an investment theme?
Well, it's quite interesting because, people have been itching to buy European stocks, as an example, because they're so much cheaper than US stocks. That hasn't been a good idea. I don't think it's a particularly good idea now, unless some of the DOGE types of ideas start to spread over to Europe. And among our European clients, they are hopeful that perhaps with the dollar getting as strong as it is, that the Trump administration will actually wind up putting pressure on European economies to become more competitive and to focus more on innovation. At that point, frankly, I could justify increased investments in Europe. But until that time, I think the premium in US stocks is going to continue.
So the Fed versus administration, the Fed chair sweepstakes begin. What's at stake there?
Well, again, this has going to have a lot to do with the credibility of both the Fed and perhaps the administration with regard to inflation and interest rates. Chairman Powell's mandate as chairman ends in May of 2026. So by the end of this year, they'll be talking about who his replacement will be. I'm fully expecting him to be replaced. I think the president has talked about the idea that he wants to maintain the independence of the Fed, which is great. My own opinion, the Fed should have a little bit more humility about its actions, and that it unfortunately tends to play the role of pyromaniac and fireman by getting too confident in its own actions.
You are calling for a hedge fund revival. It has been a private equity market for a while. Hedge funds have definitely taken a back seat as far as their performance. Why do you think there's going to be a revival in hedge funds?
There should be a little more volatility in the markets, and I think longer-term interest rates are going to be a bit higher. I can't think of an industry that's benefited more from what we call quantitative easing or keeping interest rates artificially low than private equity, which relies on borrowed money. I think to the extent to which the cost of debt capital moves higher, those returns from private equity may be not as enticing. It also, though, the volatility may provide the basis for better performance from long-short hedge funds that both buy and short stocks.
The animal spirits revival is another one of your major investment themes for this year. IPOs and deal making. Talk to us about that.
I think last year, there was a lot of government spending. There were a lot of government actions to keep the economy going. We drew down the Strategic Petroleum Reserve. We forgave student loans. We were spending a lot of money. But one of the things that didn't happen, because I think that the differences in the candidates, Trump and Biden and then Trump and Harris, were so great that many businessmen and women didn't really do the types of deals that they normally would do because the range of economic outcomes was potentially so wide, particularly as it relates to that tax cut, the Tax Cut and Jobs Act from Trump's first administration. To the extent to which that's more likely to be passed, it gives business people a much greater confidence that they can do these deals without the rules of the game changing. And so you're already seeing that, I think, initially in early on in 2025, and I would expect that to continue throughout this year. There were a lot of deals that were put on hold last year that will come to the forefront this year.
So from an investor point of view, there are going to be more opportunities to invest in public companies, you think, than there have been in the past?
I believe so. And private equity usually is, these days, often is the entity taking these companies public. But the market was largely kind of shut down, partly because of this sclerotic nature of our politics. To the extent to which that's over, I think that the private equity sponsors are going to feel more confident taking some of these companies public and giving average people the chance to invest in some of these high growth companies in the public sphere.
And Jason, the final one is the desperate search for industrial power, unresolved question, continuing pace of capital spending on artificial intelligence.
particularly on the industrial power revolution, that is one of our big themes for this year. It's very much in our Strategic Macro Thematic Opportunities Fund. And the idea largely is that whether it's electric vehicles, whether it's crypto mining, whether it's the fact that there's still a billion people on Earth that don't have access to electricity, we desperately need more electricity in this country and in the developed world. As you may know, artificial intelligence searches oftentimes use 10 times as much electricity as a Google search.
Right, it's just incredible.
So the demand for electricity is going up dramatically, and that means we're going to have to find companies that are either going to provide the natural gas or nuclear energy that could provide for more electricity, or also find other companies that are going to modernize our electric grid so that we can transport more power throughout the United States. To me, that's a very strong long-term theme. It goes hand in hand largely with the artificial intelligence theme that I think is going to continue, where companies are going to continue to spend money on this, but they can only really effectively spend money on it if they have access to relatively cheap electricity.
So how does one invest in that theme, the fact that there is this tremendous demand for electricity, for power?
There are a number of companies that you can invest in utilities, a company like Duke Energy. You can invest in, one of our favorite names is a company called NuScale. The symbol is SMR. That stands for Small Modular Reactors, SMR. So they make smaller nuclear reactors that don't take as much time or don't require as much capital to get up and running.
When was the last time that utilities were in the spotlight as an attractive place to invest? It was a long time ago. They were income plays.
Yeah,
Right.
It's exactly right. And here it's becoming more of a secular growth story. Now, the utilities, you have to be a little careful because they are regulated, and their ability to pass on price increases may be somewhat more limited than it normally is. But there are certain utilities that are well ahead of the game in terms of modernizing their own grids, and will have an ability, maybe if they don't increase the prices as much, can provide a lot more electricity, can make it up a little bit on the volume side.
And of course, the other part of that, and you mentioned that with SMR, is that nuclear power is suddenly back in vogue as well.
It's a big change, I think, and that's true in this. That's very much true in this administration. The problem, of course, with some of the renewable wind and solar is that they're not particularly scalable. They're not as financially viable without government subsidies. And so, whereas these other, whether it's natural gas or nuclear, they very much make a lot of sense financially if you can get the private capital. And I think there'll be a fair amount of private capital ready to invest. The technology, unfortunately, is not quite there for wind and solar. So in many cases, the wind has to be winding, and the sun has to be shining for you to be able to provide the types of electricity reliably and cheaply. And that technology may change over time, but the technology is not there just yet.
Your team comes up with all of these neat facts. And one of the facts that I read recently was that, that the last 2 years we've had these back-to-back double-digit increases in the S&P 500. I think the best 2-year period since 1998. What does that tell you about a third year?
You do have to have a big increase in animal spirits. You and I both remember that period very well. And one of the things that spurred that bull market to last as long as it did is you had widespread, for lack of a better term, retail or individual investment participation in individual stocks. I think a lot of people are quite invested right now, individuals. I'm not sure how much pent-up demand there is for some of these stocks. So it may be difficult to get that third year of 20% plus types of returns. Personally, I would view that as a good thing, just to allow the earnings to catch up to the valuations, and so the market doesn't look quite as expensive, and you're not met with some sort of untoward event in the interim. I'd rather see this be more sustainable increase in the stock market as opposed to kind of a blow off top in which after 2002, market fell 50%. I'd rather avoid that and kind of go slow and steady ascent in the overall market.
Jason, I mentioned in my introduction to you that you're known for some of your calls, and one of the most famous ones was coining the phrase, Tina, there is no alternative to stocks. which described how attractive stocks were versus fixed income when interest rates were near zero for a number of years. Is there a next TINA that's going to be one of those major investable themes, or is that kind of a once in a generation?
I kind of hope that's kind of a once in a generation.
Okay.
I'm very skeptical of the Fed's willingness to suppress interest rates artificially for 14 years. I think that was very regressive. But that's what created TINA. The Fed, it was quite literally their intention was to make bonds really not particularly attractive and get people to take more risk. The problem with that is that if you're not particularly rich, if you just have savings, you get zero on your savings. You get very low interest rates on your treasury bills. And so it tends to be very good for rich people and not particularly good for the average person. And so I kind of believe more in free markets. I do think this industrial power theme is one of those things. There's no such thing as a sure thing in the investment business. Of course, there's always a trap door. There's always something that can go wrong. Right now, from my point of view, that's the most compelling theme that I see out there.
And Jason, let me ask you about the zeitgeist, just what people have been talking about. There's a vibe change, something that Neil Ferguson has talked about. The fact that the businesses are more optimistic, that entrepreneurs, Silicon Valley, that there's a sense that we're in a kind of a new era of encouraging entrepreneurship, of deregulation, of again, I'd have to say kind of animal spirits in both business and in the markets. What's your read of the zeitgeist?
Neil, is one of my heroes. And I think one of the things he said was that in addition to Trump winning, which was surprising, what was even more surprising is that some of these feelings, some of these ideas that he has have gone global. Other places around the world are starting to look and say perhaps government has too much power. And I think COVID obviously set off a series of events in which, and we were scared and we didn't know, but at the end of the day, I think a lot of people have come to the conclusion that we were putting perhaps too much power in the hands of government. And I think there's a sense now that the economies and societies should be somewhat more balanced, not only in terms of the economy, but also in terms of free speech. And so I think that is liberating for a lot of companies.
Do you see manifestations of that, not just in the stock market, but also in the economy at large?
I think if you look at some of corporate policies, I think JP Morgan just announced that people have to be back 5 days a week. Again, that would have probably seen as somewhat politically incorrect a year or two ago, but now I think people are getting down to the idea that the business of America is business.
Back to the basics of investments. One investment for a long-term diversified portfolio. Cameco was your choice a year ago. It's up on the year. What would your choice be today to add to a long-term diversified portfolio?
I mentioned it before, but I like this company called NuScale, symbol SMR, and because I do think that they have a fair amount of government contracts. The government understands, the Department of Energy understands that nuclear is going to have to be a part of the solution. They've also approved some of their plans, their design plans for smaller modular nuclear reactors that can be put into communities a little bit more quickly and a little bit more cheaply. And to me, that's in the early stages of its growth trajectory, and there's not a lot of competition. Companies trading at about $20 a share. Well, it's a little speculative, but I do think for those who want to play this theme, it's a good place to be.
Jason Trennert, thanks so much for joining us for our annual sit-down about the outlook for the economy, markets, and also your investment themes for the new year.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is give your portfolio a contrarian's review. Do you own any markets or sectors that have underperformed over the last year or two? That's where many of Wealth Track's great investor guests search for bargains. Trennert's team at Strategas points out that the European market, represented by the MSCI Europe Index, has dramatically underperformed the S&P 500 for several years, noting that the valuation disparity is about as big as it's ever been. Consider adding some European exposure to your portfolio. For the most part, small company stocks have underperformed large company ones for a decade or more. With the political and business focus on American companies, undervalued small caps should be able to hold their own once again. Looking at specific sectors, when was the last time you owned an electric utility? The sector was a stellar performer last year, but demand for electricity is soaring from artificial intelligence, data transmission, and even cryptocurrency mining with no end in sight. As T. Rowe Price great investor David Giroux told us recently, regulated utilities remain one of his favorite sectors. Overlooked and underperforming markets and industries tend to be where the best long-term values can be found. They also add to portfolio diversification. Next week, outspoken and widely followed economist David Rosenberg explains why he is rethinking his stock market bubble thesis. In this week's extra feature, Jason Trennert discusses why talking to the man on the street is an integral part of his investment research. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending time with us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.